Welcome everyone to our basic sales and use tax for nonprofit organizations. My name is Ling and I'm the membership director at California Association of Nonprofits, Count Nonprofits for short. And next, I would like to introduce our presenter, Christiansen, the California Department of Tax and Fee Administration. Welcome, Lance, and please take it away.
All right, thank you, Lane. And my name is Lance Christiansen. I'm an information officer, actually, with the California Department of Tax and Fee Administration. So this is what I do. I normally am talking to business owners, but because of today's webinar, we'll be talking to you folks who are involved with nonprofits. And the rules can be similar in many ways as far as sales tax is concerned, and it can be slightly different in many ways as well. So that's what we hope that today's tailored presentation can help you with for today. I did want to also introduce my colleague who will be helping out in the Q&A, and my friend Hany Malek. Morning, Hany.
Hi, good morning, everyone. Good morning, Lance. How's everything with you today? My name is Hany Malek, Senior Tax Auditor with California Department of Tax and Fees. As Lance mentioned, I'm going to be handling here your questions. If you have any questions, feel free to type your question. I try to answer you during Lance's presentation. If you choose to wait until the end and ask your question, probably your presentation covering the answer. Lance has a very comprehensive presentation, so hopefully you enjoy it. If you have a question, just list it in Q&A, and I'm gonna keep answering your questions, or you can wait until end and we're gonna go over your question again. Thank you, Lance.
All right, thank you, Hany. Okay, let's get ahead and get underway here. So the first thing I do need to point out to you is that even though this is an approved presentation from the CDTFA, and I will be using the best of my sales and use tax knowledge as it applies to nonprofit organizations, as will Hany in the Q&A, none of this actually constitutes legally reliable written tax guidance from the CDTFA. Now, if you ever want that, just like any business owner, you can always get it, and it's absolutely free. If you want peace of mind because you want something written down on a piece of paper, we can absolutely get that to you. And the way you do it is you write to your local office. Usually it's when you might have a particular question, like maybe you're a nonprofit and you're trying to figure out which type of nonprofit you are, because the rules sort of vary from one to another. And you need a clarification on that. So what you could do, you could write to your local office, tell them who you are, ask your actual question, and then make sure you ask for a written response back. We will give you that, and from that point forward, you just follow whatever it is that we told you, and you'll be free from any tax liability. So that is always available to you. Again, you can do it by writing to your local office. So what you see on your screen now is the homepage for us, cdtfa.ca.gov. And you can look over there on the right down at the bottom. This is the front page, bottom, and you can see where it says office locations. So if you click on that, it'll show all the different locations throughout the state. Just pick out the one that's closest to you. That's who you could write your letter to. Now, if you don't want to do it by writing a letter, you can also do it by emailing us. Look right above that circle I just created. It says email the CDTFA. When you click on that, this little form is going to open up, and you can just put in your contact information, and at the very bottom, you'll find the place where you write your question in. We usually ask for about 9 business days for us to get you a written response back. Again, make sure you ask for that written response. If we can't get it in 9 days and we're still researching it, we'll let you know that too. So just know that this is available to everyone free of charge if you want peace of mind on a particular issue. Okay, so what are the objectives of today's webinar? Well, we're going to give you the basic understanding of sales and use tax, particularly as it applies to nonprofit organizations. Going to illustrate some of the concepts that are specific just to you folks, and also make sure that you're aware of all the CDTFA services that are available to you. Now, the first thing I need to point out, unfortunately, there is no blanket exemption from sales or use tax just because you're a nonprofit or a charitable organization. Wouldn't that have been nice if I could have just said, yep, you're a nonprofit, you don't have to worry about taxes. Have a good day. But unfortunately, that is not the case. So there's definitely rules that apply to you as well. Basically, your organization's sales of what we call tangible personal property, which is a fancy way of saying things that you sell to raise money, generally subject to tax, just like any business. Generally, when you make purchases as a nonprofit of tangible personal property, things including supplies and such, generally they're subject to tax. Sometimes people get that 501c3 designation and they think all their tax is gone, but that doesn't apply to sales tax, and that's why we're talking today. Certain exemptions will apply to you, and certain exemptions will apply to other nonprofits. So I strongly suggest, while we're going through this today, you look for yours. Look for the type of nonprofit that you're involved with, because the rules vary from one nonprofit to another, depending on the type of nonprofit you are. Some get this sort of an exemption, some get others. Some operate just like a business, which isn't a bad thing as long as you know how you're supposed to be operating. So that's what I suggest today. We'll be talking about a lot of different types. If I'm talking about one that's not you, don't worry about it. Wait till I'm talking about the part that it applies to your type of nonprofit. Once you are a nonprofit that is making sales, then you need to make sure that you keep good records. In general, you are going to be keeping your records, and we'll talk more about how long, et cetera, as we go on. But once you get that seller's permit from us, you need to keep records. As Hany will tell you, when he goes and audits people, the better the records you have, the better your audit is and smoother your audit is going to go. A nonprofit is responsible for maintaining and providing documentation in case they're ever audited. Nonprofits do get audited. Same rules, again, like a business would. A seller, and in this case, we're talking to you folks, nonprofits are responsible for paying sales tax. But the great thing about sales tax, as opposed to income tax, is it's not really coming out of your pocket. Your customers or your donors who are making purchases during your fundraising, they're the ones that are paying the tax. You're sort of the middleman when it comes to sales tax. You just hold it, and then when it's time for you to file it, you file it and pay your tax. But it's not coming out of your proceeds. So that's a beautiful thing about sales tax as taxes go. So we talk a lot about tangible personal property. And if I may, from this point forward, that's the state's way of saying things. If you sell things, then a lot of times they're going to be taxable. Now, tangible personal property can be anything that can be touched, held, weighed, or measured. So if you look at the pictures on your screen right now, on the left, it looks like there's maybe a silent auction going on. You see there's like a drill. You can touch and hold that, drill bits. Looks like there's a home composter, maybe next to that, a gift basket, which is full of lots of things you can touch and hold. On the right picture, it looks like a fireworks stand, perhaps, and fireworks you can hold and touch and measure. So those are the things that are taxable in California. If it's like a service, that's not taxable in California. So a dog groomer is not taxable. Someone who's a party DJ, not taxable. They're providing a service. The only way that would be taxable is if the party DJ also sells CDs, which you can touch or hold. Or the dog groomer also sells shampoo or dog toys. Those things would be taxable. But the service of trimming the dog's hair, not taxable. The service of the party DJ providing entertainment, not taxable, just tangible things in California. So you got that, hopefully. Now you will need to know what a sale is. And more importantly, when does a sale take place? So the sale takes place when the things, TPP, change hands from the person selling it, and then you're receiving a payment. But don't get caught up on when the payment is received, because that doesn't enter into when a sale takes place. And if you understand when a sale takes place, a lot of the rest of what we're going to talk about will make more sense to you. So the sale takes place again when the merchandise changes hands. So if you sold something during a fundraiser and you told the person who purchased it, you don't have to pay me for 3 months. Okay, that's fine. Just know during the month that you exchanged that property, that's when the sale took place for sales tax purposes. And that's the period when you go to file that you'll need to pay that tax, even though you've collected no money yet. Same thing if it's the other way around. Someone bought something from you that was rather expensive, and maybe they're making payments for a while, but you haven't given it over to them yet. Well, they can make months and months of payments, but until you actually give them that piece of tangible personal property, the thing, then the sale hasn't taken place yet for tax purposes. So just keep that in mind as we go forward, that that's when a sale takes place, when the merchandise changes hands. All right, these are some of the activities that are going to be generally taxable for nonprofits. Yes, raffles can be, and we'll talk more about that. Food sales are pretty common, rummage sales, auctions, bazaars, carnival booths, internet sales, vending machine sales, all those have something exchanging hands, tangible personal property. So we've been talking about how services are not. So say you're doing a fundraiser and you're giving away the 3 things that are depicted by these pictures on your screen right now. So the first one maybe is a trip to Hawaii. Second one is a new set of golf clubs. And the third one is a day in the spa. Well, that trip to Hawaii, you can't touch that, weigh that, or hold that, or measure it. Might be fun, but you can't do anything. It's not tangible, so that wouldn't be taxable. The golf clubs, certainly you can grab a hold of those and touch them and weigh them. That would be something that's taxable for you. The last one, again, a trip to the spa, you're just being pampered and having things done to you to relax, etc. None of those things would be taxable either. So the trip to the spa that you're auctioning off would not be taxable. So hopefully you're getting an idea of what things are and what things are not.
Lance, this is Jan at Cal Nonprofits. Let me just interrupt you for one quick question. So one is, let me just say, you're talking about when nonprofits sell things, right? When
Yes.
nonprofits buy things, we pay sales tax, right?
So yeah, when nonprofits, we'll just say in general, when nonprofits are buying things, most of the time they have to pay tax.
Okay, great. Thanks.
Absolutely, absolutely. And there'll be some examples of where they don't, but generally speaking, yep, you have to pay tax.
And then you said earlier that raffles are sales tax. Do you mean sale of raffle tickets? If I sell 10 tickets for $10, so I have to charge sales tax on that?
Yeah, if I can postpone that a little bit, we're going to talk a little bit more about raffles. And I knew that would be of interest since lots of people are doing them. So I'll make a point of expanding on that if that's okay. Okay. All right. Thank you, Jan. So let's get to some different types of nonprofits. So there's some nonprofits who are lucky enough, just a handful, who are lucky enough to be considered consumers. And what does that mean if you're a nonprofit that's a consumer? What it means is when you're getting the items that you are going to maybe auction off and sell to raise funds, as long as you pay tax up front on those items, so you're getting t-shirts that you're going to sell, you pay the tax on the t-shirt when you get it, or you're getting a lot of beads to make necklaces or jewelry. If you pay tax on those beads up front, then if you're considered a consumer, then guess what? You don't have to charge tax when it comes time for you to sell it. because you have that designation as a consumer, but there's only a few that fall into that category as being consumers. Let's take a look at those. So if you are an organization that serves developmentally disabled children with severe emotional disturbances, you could be considered a consumer. PTAs, parent-teacher associations, they are consumers. A parent cooperative nursery school, similarly, is also considered a consumer. And friends of the library organizations, they are consumers, and volunteer fire departments. So if you are one of those nonprofits, then that's sort of your rules, is just pay the tax up front when you go and buy things that you're going to resell to raise money, and you don't have to charge tax when you do the reselling. But these are the only consumers. Okay, so let's move on. If you are not on that list, and the other thing I should have pointed out was, if you are a consumer, guess what? You don't need a seller's permit from us. But if you're not, which is still probably the majority of you on today's webinar, then you need to get a seller's permit from us. So it doesn't matter if you're a person or a corporation or nonprofit, if you're selling or leasing those things, then you need to get a seller's permit. Now, I will point out that you can, if you make less than 2 or more than 2 sales in a 12-month period, then that's when you need to have a seller's permit. If you do 1 sale a year, basically what it means is you're an occasional seller. We were talking before the webinar came on about like a garage sale. Technically, a garage sale, you can have 2 a year. If you have 3 a year, you're a retailer and you need to get a seller's permit. I know we all have that garage sale person somewhere in our neighborhood, right? So that's the same thing with nonprofits. You can have up to 2 sales a year. If you have more than that, then you need to get a seller's permit from us. And let me point out again, seller's permit doesn't cost you anything. There is no fee for a seller's permit. It's just something that you have to have. So how do you go about getting a seller's permit from the CDTFA? Pretty easy. Here's the front of our website again, cdtfa.ca.gov. Right there at the top, you would just click on log in and register. That's going to take you to this page, and you're going to register a new business activity. We'll also be asking you, by the way, to create a username and password, just like you've done on lots of other websites. So then you're going to register a new business activity, and it's going to take you over to this page. And what we're going to do is ask you a bunch of mainly just yes and no questions, some multiple choice to figure out what kind of business or nonprofit you are, if you even need a seller's permit. We'll also decide how often it is you're going to need to file a return with us. Is it once a year, once a quarter, once a month? So all that we'll be able to determine by the questions that you answer. So by the time you're all done, you have a seller's permit. And notice you haven't had to go into the office. You can come into our office, but you can do the whole thing online. All right. Now, it's mentioning when you're getting your seller's permit at that time, depending on what you tell us, which I can tell you has a lot to do with how much fundraising you do, things like that, we'll decide if you file once a year, once a fiscal year, which is usually determined about when it is you're getting your seller's permit, once a quarter, and whenever it is, you file and pay always the following month. So if you're on the yearly plan, you'll make your sales from January through December. The following January, that's when you'll file a return with us and pay the sales tax. If you're on a fiscal year, you'll go through June 30th. So you'll have all of the following July to make that payment and to file your return. Quarter system, January, February, March. So then April is the first return. Then you do fundraising for April, May, June. July will be your next return. So that's always the way it works. Also, we like to point out, because a lot of people run out and get their seller's permit, and maybe they're not quite ready to start their fundraising yet. Now their time to file rolls around. Don't assume because you've made no sales, or even if you've skipped a fundraiser for a year, If you have a permit with us, don't assume that because you've made no sales, you don't file a return. You still do. Even if you had zero income, you still would file a return. It'd be a very easy return for you, I can tell you, because you'll just be filing zero, but you still have to do it because we don't know what's going on with you. Last we heard, you needed a seller's permit because you were going to be doing selling. We don't know if something has changed, so make sure you file that return. And you can do the return online too, by the way. Everything's gone online. You never have to leave your house. You don't have to worry about paperwork, okay? Now, some of you might prefer or might be easier for you to get a temporary seller's permit. Generally, if you are making sales for 90 days or less, so I might think of something like a Christmas tree lot or a fireworks stand, that sort of a thing, maybe you want to get a temporary seller's permit. And on the other hand, you can still get a regular seller's permit that lasts you all the time. And if it's something you're annually selling every year, you have that fireworks stand, you might want to just get the full year's seller's permit. Again, they don't cost anything. And then you don't have to keep getting a new one, getting a new one, getting a new one every time you're trying to do some sort of fundraising. It'll just cover you no matter what you decide to do throughout the year, okay? If you do get that temporary permit, it's the same story. Once the temporary permit is done, in that 90 days or less, it's the following month that you would file your return. So if you had one for the fireworks stand, July gets done, August is when all the sales tax will be due, and that's when you would be filing. Okay. All right. So one of the perks about having a seller's permit is now you can use resale certificates just like a business does. So resale certificates are like those mini contracts between you and the person you're buying things you're going to sell, where you say, hey, soda company, don't charge me any tax on these sodas because when I sell them through our organization, I'll collect the tax from my customer. Okay, that's exactly what a resale certificate is for. Here's all the sodas tax-free. So it's just pushing on that I'm going to resell these items. So if you are making quilts, as it shows in the picture, you can go and buy all your material tax-free by issuing a resale certificate to the vendor that you're purchasing that material from. You make the quilts, then you just got to make sure when you sell them that you collect the tax then. But in the meantime, you can get all the things that you're going to resell tax-free from your vendor by issuing a resale certificate. Now, a resale certificate just needs to have these items on it. So if you're the purchaser, your name, your address, your seller's permit that you have will go on there. The items that are being purchased, and here's where I like to tell people to maybe be a little on the vague side to save yourself some time. So if you were buying sodas that you're going to sell, don't say, I am buying Coca-Cola, because next month when you need Mountain Dew and the following month when you need 7-Up, you'll have to give them another seller's permit. Whereas if you just put sodas, anything that falls under the sodas umbrella, you'll be covered for, because a seller's permit, a resale certificate, I'm sorry, does not expire. The vendor will just keep it on hand. And then as long as you're buying something that falls under the umbrella of sodas, you won't have to give them another one. So it'll save you some time. It needs to say on that resale certificate that you are purchasing it for resale. That's the only thing you should be using a resale certificate for, the things you're going to resell. So not the computer that you're running your business or your nonprofit with, not the office furniture that you're using in the nonprofit office, just the things you're going to resell. You sign it, you date it, you have a good resale certificate. Now we have one. You don't have to use ours, but you can go to our website. It's Form 230. As you can see, just fill in the blanks. And when you're done, then you can print it out and hand it over to your vendor. But you can make your own as well, or you can get them in any business supply store. As long as it has those things that I went through, then you'll have a perfectly good resale certificate. Okay, before we get too far along, I need to bring up use tax. Now, use tax is something that not only nonprofits pay, but regular businesses pay as well. And all of us as individuals, honestly, are supposed to pay, but I'm talking to nonprofits today. So when do we generate use tax in California? For one thing, it's been around since 1935. Sometimes people think it's something new because they haven't heard of it, but it's been around a long time. So if you buy something that's taxable in California, but the person you bought it from doesn't charge you any tax for some reason, and usually these days it's because that company that's selling it to you may be out of state. Maybe you bought a computer for your nonprofit from Connecticut Computers R Us online, and they're shipping it to you. They might not charge you any sales tax because for them it's an out-of-state sale. Just like if you were to sell something to someone who lives in Texas and you send it to them, you don't have to charge them any sales tax. For you, it's an out-of-state sale. But if you're going to use that computer in California, then you're going to have to pay use tax. And use tax is the exact same tax rate as your current sales tax rate. So if your sales tax rate where your nonprofit is 7.75, your use tax rate is 7.75. And if you're not sure why this came about, use tax, the whole idea was actually to protect California businesses early on, back in the 30s, because they would find that, well, we're at a disadvantage against businesses out of state because they don't have to charge tax, but we do. Well, in this case, okay, buy something from out of state, but when you use it here in California, you're going to have to pay the same tax anyway. So it's a level playing field. So that's when you generate use tax. It's when you buy something generally from out of state that would normally be taxable. They don't charge you sales tax, and look to see if they do, because some might, if they have some sort of a nexus in California. If they charge you sales tax, you're good, you're done. But if they don't, then you owe use tax. All right. That's the one way you generate use tax. Now, there is a second way that you can generate use tax too. We'll take Billy here. We'll say Billy is a retailer, maybe he's a nonprofit retailer of bicycles. So he goes to Schwinn, gives them a resale certificate, says, Schwinn, don't charge me for these bikes because when I sell them in my nonprofit, I am going to collect the tax then. Great, here's all the bicycles. But before he gets them all sold, his son's birthday rolls around and his son has been eyeing those bicycles. So Billy pulls one of those so far tax-free bicycles out of his inventory, gives it to his son as a gift. Now, what has Billy just done? He's generated use tax. So if I go back to my example of you buying sodas, for instance, as long as you're going to sell those sodas, there's no use tax. But you decide to drink a few yourself, or give them away to other members of your nonprofit, or give them away as gifts, now you're not reselling it and not collecting tax, so you owe use tax. And in your case, and in Billy's case here, it would be based on the price he paid, not the price he was going to charge for a bicycle in his shop, but what he paid Schwinn for, or wherever he got the bicycles from. So follow those two things very carefully. If you generate use tax, buying things from out of state without paying tax, or pulling from your resale inventory and keeping them, giving them away, gifting them, giving them as free samples, anything but reselling them. Okay? All right. And speaking of use tax, this is one thing that's pretty great for nonprofits. So I just explained how generally a business, if they pull things out of their inventory and give them away, they're going to owe use tax on it, unless they give it to a nonprofit, which can be great for you if you're doing say an auction and you're going around to local businesses trying to get items that you can auction off. You can tell them, hey, by the way, when you pull this out of your inventory, you don't have to pay any use tax because you're giving it to us. It's kind of an interesting thing, because if you say it was coats, and you went to a place where, like a clothing retailer, and you wanted to get a coat. And if that retailer gives the coat to someone who's homeless, he owes use tax. He gives that same coat to a nonprofit, he doesn't owe use tax. So that's kind of a perk for being a nonprofit. You can get those donations without generating use tax for whoever's giving them to you. So that's something to keep in mind. It's a good selling point when you're going looking for those sort of things. Some other donation guidelines that you should know about. If you're making a purchase of something that you are going to then donate, you still pay tax at the time of purchase. Okay, you don't get a special release from that just because you're going to donate it. Pay tax up front. Nonprofits who are considered statutory consumers, those first 5 that we were talking about, if you get a donation, it doesn't change the rules for you. Remember when I mentioned like the PTAs and such, they're consumers. They have to pay tax up front, then they don't have to charge tax. Well, if someone happens to donate something just because they didn't pay the tax up front, that doesn't change the rules for them. They still will be able to sell them without collecting tax. They just got some donations this time. Loans of items to educational institutions. The one I think of there is maybe a car dealership loans a car for driver's ed to the local high school. There's no tax on that. And then the one thing you want to be careful about is that if you're making a sale of an item and a fundraiser, just referring to the money they're paying to you as a donation doesn't change the fact that it's a sale. Seen this before where it say, buy this item, this t-shirt, and give us a donation of $20. Just because you're calling it a donation, that doesn't mean it's suddenly a non-taxable thing. It's still a sale. Great that the proceeds are going towards your nonprofit, but it's still a sale. Just calling it a donation doesn't change that. Okay. All right, so let's get to the types of organizations now. These are the categories of different organizations that probably you might fall into one of these. You might not fall into any of them.
Hey, Lynn.
Yeah, Jen. Yeah.
I want to give you a time check. We're a little bit more than halfway through.
Okay.
Yes.
We need to be done at 12. I can't. I'm not hearing you.
Yes, Lance, our webinar ends at 12.
Okay, I'll try to keep moving.
Thank you.
These are the different types of organizations. So look for the one that you fall into. We'll touch on those a little bit more specifically. This is the one that gets closest to having a free ride when it comes to sales and use tax. Charitable organizations that relieve poverty and distress. I tend to think of like a homeless shelter. It has to meet all these qualifications. It's formed and operated for charitable purposes. We all are, right? Qualified for the property tax welfare exemption at their site where they sell merchandise. They're engaged in activities that relieve poverty and distress in particular. They sell and donate items principally to assist recipients in distressed financial conditions. And they make, prepare, assemble, and manufacture items that they sell or donate. If that sounds like you, then what you're going on to do is try to get a welfare exemption, because what will result from it, if you can get it, you don't have to charge on any sales, and you won't have to be charged tax when you're going and buying certain things. So it's a little bit more of an involved process. You can find out about that process through the Board of Equalization. They have a pub called 149, Property Tax Welfare Exemption. In a nutshell, what you're going to end up doing is taking this form 277 and you're filing it with the BOE to receive an organizational clearance certificate. When they look at it, they'll give it back to you and you'll submit that plus some other paperwork to your local county assessor. If that goes through okay, then they will give it back to you. And what will happen is you'll type up a description of your organization, a letter describing your practices, the letters from the Franchise Tax Board or IRS showing your 501c3, a copy of your articles of incorporation, and that welfare exemption verification that you got from your from the BOE and from your assessor. Then you'll send it to us. This is the address that you send it to, and we'll look it over. And if it's all good, we will give you verify your exempt status, and that will make it so we'll even give you an organizational letter that you can take when you go to buy things and show that you are supposed to be getting tax-free. So if that sounds like you, go ahead and investigate that further, because it certainly could help you. All right, for the rest of us though, let's get into your types of organizations. First, cultural organizations like government art programs, library support organizations, zoological societies, museums. What's the rules that you follow? Well, one thing I wanted to tell you is that a lot of times might be a museum with works of art. Are they taxable? Generally not, but you got to follow these things. So the works of art that are going to hang in a museum, these are the rules. A state or a city or a county or other government entity is involved in the purchase of that or running the museum, or a nonprofit organization, like maybe yourself operating a public museum that's linked in with that government, if you're making the purchase of the art, or a nonprofit organization who's exempt from state income tax for that museum that happens to be open at least 35 weeks a year for at least 20 hours a week. Sounds like a full-time museum, in other words. Or any buyer from a retailer who is making a purchase of that and donating it for the hanging. All those are instances where there would be no tax on that particular piece of artwork. So that can be helpful if you're a cultural organization or museum. Now, there's a lot of veterans organizations. Generally, you hold a seller's permit, just like everybody else. Generally, the items you sell are taxable, except for American flags, at which time you're the consumer of those. So you pay the tax up front when you buy the flag, but then when you sell it, you don't have to. Or if you're selling buddy poppies, you know, the little poppies that you get from the veterans of foreign war that commemorate military veterans who were killed in service. Those are the things that you can sell actually tax-free. And purchase tax-free, I might add, as far as those pins are concerned. What else with veterans organizations? Well, as with many organizations, you do have special food conditions. So tax doesn't apply to your pancake breakfast or your spaghetti dinner if you sell the food or the meals at a social gathering that you're conducting. Doesn't have to be at your one location either, it can be anywhere, but you're conducting that actual dinner or breakfast. You furnish the meals or the food to raise funds for, of course, your organization. Use the proceeds to carry out those functions. The other thing that's common throughout nonprofits and with businesses is carbonated and alcoholic beverages sold separately are different. So those are always taxable. If you are selling carbonated or alcoholic beverages individually, doesn't matter what kind of a nonprofit is, those are always going to be taxable. Okay, even if you have one of these special food condition exemptions. Let's move on to religious organizations. Need a seller's permit. Your sales and purchases generally taxable except for a special meal situation again. Your sales might include such things as auctions, festivals, craft shows, sales at church bookstores, from tables that you have at events, even internet and mail order sales, all taxable, just like a business would be. But you have some special meal exemptions, just like veterans did. So if they're meals or food products that are serving for your fundraising purpose, and you're a 501c3, so you already have a property tax exemption, then your meals can actually not be charged, not be taxed. Here's some other rules for you. These conditions must be met as similar to the veterans. Your food must be sold at a social gathering that you're conducting. Of course, all the proceeds go towards your activities and your functions. You can use a resale certificate to buy meals if they're coming from a restaurant, for instance, or a fast food provider. You can give them a resale certificate and then resell it, and you still won't have to charge tax on those. Again, carbonated beverages, though, sold separately, they're always going to be taxable. Let's move on to a social or fraternal organization. Those are usually things like service clubs and lodges, a country club, an athletic club, those sort of things. Your sales and purchases, generally taxable. You've got a meal exemption coming too. It's a little thinner. Generally, your sales on such things as auctions and festivals, etc., going to be taxable. So here's your meal exemption. It's basically just for the members of your organization. So you sell meals or food exclusively to your members. And that is being done less than once a week. So you have a monthly banquet, for instance. Those meals you don't have to charge tax on, but it's only for members. It's only for members. It can't have the general public coming in. If the general public does come in, you need to pay for their meal. Okay. So if a non-member attends even one dinner, pays for their own meal, then guess what? It makes all the meals to your members taxable too. So just pay for them. If you have a guest speaker, pay for that guest speaker's meal. Then you can not tax anything. Again, carbonated beverages, alcoholic beverages, same story. Sold separately or taxable. If it's being catered, you can give that resale certificate. Keep in mind, if you're going to a restaurant for your banquet, those rules do not apply. You have to pay a restaurant for tax and whatever, just like a regular patron going into a restaurant, if it's taking place at the restaurant. Okay. All right, let's move on to schools. Sales of meals or food to students, not taxable when it's made by a qualifying school or organization. They need to be being sold during regular meal times, like lunch, or if it has breakfast too, not during recess and break. Those are separate types of things. Your main meals, school lunches, etc., not taxable. Sales of food products that are taxable, if you're selling to non-students, so the teachers and the faculty, they need to be taxed. If the sales or food is being done at a place where admission is being charged, like you're running a little fair and people have to pay to get in, that changes things, that changes the rules. Any food then that is supposed to be eaten there at that fair, you have to charge tax on, if they have to pay admission to get in. And then sales of non-food products such as sodas, taxable unless they're sold as part of a meal. If it's part of a combination package, then, and we'll talk about those here in a moment, that can change the taxability of it. Another thing about schools, if it's made by caterers, a lot of times these days, public schools and private schools have a caterer come in and sell their lunches to their students. Well, it can be taxable, but all these things all these implications have to be covered. Are the premises that are being used by that caterer used by the school for other purposes during the remainder of the day? In other words, they're in an auditorium or something like that, or even a football field. Are the fixtures and the equipment being used by that caterer owned by the school? That is one of the implications. And then can the students distinguish between a caterer and an employee of the school? They shouldn't be able to. So what this comes out to is, if the Domino's pizza truck rolls in, they're using their equipment, they're dressed as Domino employees, and you're not using that trailer the rest of the day in your normal school purposes, that's a different story. They need to charge tax. Okay. But if they're working on behalf of the school, hopefully they would have those other implications covered. All right, parent organizations, we did talk about how they are consumers.
Lance?
Yeah.
If I could just jump in very quickly, we are running, really low on time. So I wanted to share just a couple of things real quick. Number one, the recording will be sent out to everyone if you have to drop off. Lance, do you think if we extended by 10 or 15 minutes, do you think we'll have enough time to wrap up?
I think so. Yeah, what is
Okay.
the time? Let's say how
We
far?
are at
Oh, 10 minutes. still.
11:50 now, yeah. And I think we've still got some pretty detailed calculation slides. So I just wanted to let folks know we will stay a little bit, past 12, if that's good with you, Lance. If you have any
That's fine.
questions and you have to drop off, please put those in the Q&A box. And when you get the recording, you should get the answers to those questions. And I will back away because, like I said, we're already running past, so I don't want to take any further time.
All right, I'll try to keep it moving. Thanks, David. All right, in that case, I'm not going to talk too much more about parent organizations, PTAs and stuff. We already determined that they are consumers, so they're paying the tax up front, remember, okay? So I'm going to go ahead. You do need to be, though, a PTA that is associated or chartered by the California Congress of Parent Teachers and Students, or an equivalent within the school, or at least operated by the school's governing authority to be a recognized PTA. Nonprofit youth organizations might be doing sales of wrapping paper and t-shirts and that sort of thing. Examples of them would be Little Leagues, Boy Scouts, YMCA, YWCA, 4-H clubs, those sort of things. If your sales are not going to be taxable if you're a 501c organization and you're providing, for instance, competitive sports, the local or the school. I guess it wouldn't be the school in this case, but it would be a Little League, that sort of thing. Also, though, if you are affiliated with a school, that's good. You sell food products, non-alcoholic beverages, items made by you, you make sales on a irregular basis, then those aren't going to be taxable for you if you are a nonprofit youth organization, right? Also, thrift stores, in particular, HIV or AIDS related thrift stores, where the proceeds are going to HIV or AIDS. At least 75% of the store's proceeds go towards hospice and social services, etc. They have an exemption, so they don't charge tax. And I'll just quickly throw in, that's the same story for a thrift store on a military base. That just recently got extended. They have an exemption, don't have to charge sales tax. Organizations that serve meals, nonprofit home delivery organizations, I'm thinking Meals on Wheels, not taxable as long as the meals are served at or below the organization's cost, and that those meals are being financed under some state or federally financed program. Also, these sort of facilities are not going to be taxable if you are serving in a healthcare facility, community care, residential care for elderly, recovery, like alcohol recovery, drug recovery, et cetera, retirement homes. They don't have to charge tax. Now, if you haven't been touched on yet, your particular nonprofit, then you operate like a business. And if you're doing food sales, you're going to operate just like a restaurant. So let me point out what the basic rules are for a restaurant, what's taxable and what isn't. I think it's easiest just to say what's taxable first. First, are the people who you're selling to going to eat it right there on your premises? If they are, it's taxable. Doesn't matter what kind of food it is. That's why a restaurant asks, is this for here to go? Because if it's for here, it doesn't matter the food, it's going to be taxable. The second thing is it a hot food? Because if it's a hot food, 80% of the time, even if it's to go, it's going to be taxable. So those are the two constants. Are they eating it there, or is it hot food? Then it's going to be a taxable sale for you. So of course, I did say 80% of the time with hot food. So what does that leave? Well, if it's a to-go sale of a hot beverage, like coffee or tea, not taxable if it's to go. Or a hot bakery good, bagel, pretzel, sweet roll bread, not going to be taxable if it's to go. Other times when food might be taxable though, again, if its admission is charged at wherever the food is being sold to get in, that makes food that's meant to be eaten there, cold, hot, whatever, taxable. Also some combo meals, and we'll get into those right now. Combination packages, you know what a combo meal is. Drink, main course, maybe a side course for one price. How does that get taxed? It depends. So like, here's a couple of different types of combo meals. Hot sandwich and iced tea, package number one. Cold sandwich with fries and hot tea. What do they have in common? They all have something hot thrown in there. If you throw any hot item, even that hot tea that wouldn't be taxable if it was sold by itself, throw any hot item in a combo meal, you need to charge tax on the entire combo meal. Okay. Let's look at another package. Cold turkey sandwich and a soda. Well, it's cold and it's to go, so it's almost not taxable, except what did we say? Sodas, carbonated beverages, always taxable. So in that case, you would only tax the price of the soda. How do you do that? Well, think what it would be if you sold them separately. A soda is $2, turkey sandwich $4, but you do a combo meal, give them a break, take $1 off that. What would be the taxable amount? Here's how you figure that out. If you weren't doing the combo meal, that total would be $6 for those two items. We know only the soda is taxable, so divide the price of the soda into the total, you get 33%. Apply 33% to what you're charging for the combo meal. That would come out, in this case, to $1.65 is the taxable portion. Only $1.65 of that $5 charge would you charge tax on. Okay. The last combo meal is the easy one. Cold sandwich, milk, nothing carbonated, and it's all to go, tax-free. Don't have to charge any tax on that. Now keep in mind, this is prepared food. If it's not prepared yet, it's not taxable. Just like you go to the grocery store, they don't charge you tax. So a chicken, a whole chicken that's not cooked, or pasta that needs to be cooked, or something that's in a size that one person wouldn't ordinarily eat, like even a cheese platter that's meant for numerous people, not taxable. It's just if one person is going to eat it, and then it's either if it's hot or if it's eaten on the premises. Okay. All right, a lot of gift basket selling going on in nonprofits, so we want to touch on those. What's the tax implications there? It depends on if you put together the gift basket and you know the price of everything, you have receipts, or if someone just gave you the gift basket already assembled, because you need to know what percent of the basket is made from non-food items, what is the container price, and you need to have records for that. So let's say you're putting this basket together, you know exactly how much everything cost. Here's a gift basket. Let's see, we know the food itself isn't taxable, but we know the non-food products, which include wine and that knife that you see there, those are the only things that would be taxable there. So if the non-food products exceed 10% of the entire contents, not including the container, then you are just going to tax those. So in this case, that whole value is worth $110, but you're only going to tax $60 because that's the only taxable item in there. The food wouldn't be taxable. That's if you have receipts. Now let's take the same one and someone just gave you the basket and you don't have any receipts for it. Same thing applies, but since you don't know the actual cost of those, of the wine and the knife, but you do know it's going to exceed over 10% of that basket, which is sort of common sense, then if you don't have documentation, you need to charge tax on the whole thing. And that leaves when a gift basket is not taxable at all. And that is if the actual non-food products. Look at this basket. The only thing in there that's taxable is that coffee mug. That's less than 10% of the entire contents. So you can charge no tax on that basket if you're selling it in a silent auction or whatever, because it's less than 10% the taxable amount. It does need to be the container, which in this case is just a little basket, has to be less than 50% of the entire cost. Keep in mind, if you were selling a Ming vase with some cookies and crackers thrown in it, people are trying to get the Ming vase, and that's worth more than anything in it. So that's why that part about the value of the overall basket has to be, the basket itself has to be less than 50%, which in most cases it would be. All right, this is simply a way of selling. A lot of people do. That is rolling the sales tax into the price of the item. Perfectly okay to do that. You're selling this for $25, out the door, tax included. But two things you have to remember if you're doing that. One, you have to tell your customer at the time of the sale, that's what you're doing. Whether it's a sign posted, something in a menu, something on a receipt that says, price includes sales tax. All price of all taxable items includes sales tax, so that they know they're paying the tax up front. That's the one thing you have to do. The second thing you'll have to do is when you go to file your return, keep in mind you'll have all this tax mixed in with your proceeds. If you just did your return, you'd end up taxing your tax, wouldn't you? So you'll have to pull that sales tax back out at that point, so you don't tax your tax and it doesn't come out of your pocket that way. This is how you do it. Pretty simple equation. You sold something for $10, tax included. You divide it by 1 plus whatever your tax rate is. So in this example, it's 7.75. That would give you $9.28 in this case. You subtract it from the 10, 72 cents is the tax that would be in there. If you did this for a whole month, maybe you have $10,000, you divide it by 1.0775, and that would give you the amount. Now, if you have a different tax rate, same thing. Just add a 1 to it, 1.875. Maybe that's your tax rate. See what you come out with. That's the way that you back the sales tax out, which is, again, very important so you don't tax your tax. Other non-taxable activities. Gifting of merchandise for a true donation. So that's if you're donating to your nonprofit, you're giving a $100 donation, and for that $100, you get a pin. That's fine. You don't have to worry about the taxability of that pin. Just make sure the donation isn't too close to what that pin would actually cost. If it's getting close to the amount what the donation is, now it looks like a sale. So it has to be sort of a complimentary item. Sales of event tickets. You've got a show that you're selling tickets to. It's not taxable unless there's food involved. If there's food involved, it makes the ticket taxable. Now, here's a tip. Put on the ticket itself how much the food value is. $100 ticket for a show, a dinner show, food value $25. Now you only have to charge tax on that $25 because remember we said service, which would be the entertainment, is not taxable. Raffle tickets. Okay, here's the thing with raffle tickets. The CDTFA doesn't care too much about that, but the Department of Justice does. I'm not representing the State Department of Justice, but they have rules that you are supposed to tell them when you're going to sell raffle tickets, explain what you're doing, and then follow up afterwards with what you did. For us, sales tax purposes, the only thing we care about is everyone doesn't win something. So if you're going to have a raffle, make sure there's losers, because if everybody wins, then what's going on? Someone pays money for a ticket and they're automatically going to get something in return. That's a sale. So as long as some people lose, you're going to be okay with us. Gift cards, gift certificates, those are all fine because until they're redeemed, it's not a taxable situation. If you're just doing a membership drive or you're selling advertising, those aren't taxable either. Speaking of periodicals and advertising and such, generally, if you're a nonprofit 501c3, you don't have to charge tax for your newspapers or periodicals. as long as they're coming out at least 4 times a year, and they're distributed maybe to the members for consideration of their membership fee, or if you're just not collecting any advertising in that newspaper or periodical, then you're fine. No tax necessary. If you're not a 501c3, then you just need to make sure that they're distributed to members in consideration of their membership fee, and the cost is no more than 10% of that fee. Okay. And by the way, if you're issuing the publication free of charge, it's not taxable. And you can even get the component parts to put together that newsletter, like ink and paper, or the flyer that's stuck in it, tax-free from your vendor. You can give them an exemption certificate. Okay. All right, we're rolling down to the end here. Books and records. 4 years is what we suggest you keep records for. Just keep 3 different categories: all your sales, purchases you've made for your nonprofit, and then any of the exemptions that we've talked about today. Make sure that your records show those exemptions. This was all the food we sold, and that was, we had the food exemption, for instance. Going forward, you can do everything on our website, including filing your return, making your payment. You'll find all of that on cdtfa.ca.gov. The other thing under tax resources that you see there in the middle, you can find this tax guide for nonprofit organizations, which is where we got most of what we talked about today. Under our industry guides, you'll see this tax guide for nonprofit organizations. You can also find our publication, Nonprofit Organizations. It'll help you figure out which one you are. You can find that online from our website under Forms and Publications. Also, if you have questions after today, you can always call our customer service center, 800-400-7115, Monday through Friday. They can answer any question that you might have. All right? All right, we're going to go ahead and skip on to the end then.
I have a question, Lance. How do people figure out how much sales tax to charge where they're located?
Okay, yeah, you can go onto our website, and there'll be a place on the very front page that says tax rates. And just look up where it is that you are doing your fundraiser. That's the tax rate you're going to want to charge. You can look it up by city, or you can even look it up by, you can put in the address of where you're going to be doing that fundraiser. And for most part, as far as nonprofits are concerned, that's the tax rate that you're going to be charging.
Thank you so much, Lance. I'm sure that the attendees share that thanks. I'm looking at the numbers. Very few people have dropped off at this point. I wanted to remind everyone again that all these very useful resources will be sent out along with the recording in the coming days for your future reference. I feel like we could do 3 sessions on this topic and break it down into each one of those areas and still probably have a wealth of information. So again, I want to thank you for your time, you and Hany, and certainly thank folks for attending. I didn't know if you had any closing comments, but I was going to end the webinar if not.
No, that's fine. If they have any other questions, again, call our customer service center. They can answer any questions about your account or a general tax question. They're always there for you.
Okay. Thank you, Lance. We get tons of questions. I would be able to answer the majority of them. The most common question, if someone need to ask about as a copy of the presentation,
I think you can get that from the nonprofit, right? Are you guys going to distribute that? Yeah,
absolutely. It'll automatically be sent out to all the registrants for the meeting today.
Okay. All right. I think that's it then, as far as we're concerned. Thanks, Hany, for your help in the Q&A, and thanks very much to Cal Nonprofits. I hope this was helpful for you.
Absolutely. Thank you all, and have a wonderful day.